So markets look calm, but really, if you're looking at the belly of the US Treasury curve, the 10 year's been quite stable, but the long end has been under pressure. So the long end's been underperforming, and the commodity complex is starting to react. If we think about the US economy, it's certainly not breaking, but it's definitely not re-accelerating either. The consensus description of the US labour market now is low hire, low fire. So policy urgency is starting to fade. Now that's been anchoring the belly of the curve. So if we think about the US 10-year, the yield's been range bound in that kind of 4.1 to 4.2 level. Volatility's been quite subdued, and markets appear to be increasingly comfortable with a patient US Federal Reserve. I'd think of this as being cyclical policy anchored pricing. But if we go further out the curve, the picture changes. So if we talk about the long end of G7 rate curves, they're increasingly driven by fiscal forces, so higher issuance, rising term premium, defense spending, tariffs, and supply side shocks as a generalization. So these are not growth fears per se, they are structural pressures. Now, why does that matter for multi asset practitioners? It's because that long end repricing not behaving like a traditional risk off move has implications for diversification. It changes how duration works in portfolios and whether we need to look at key rate durations. At the same time, global signals are starting to line up. If we think about China in a case in point, their yields are rising, producer prices are firming, and the reflation impulse in China may be slowly re-emerging. If that feeds into global inflation expectations, it could reinforce pressure at the long end of G7 curves. And we've spoke about Japan being an issue there as well. The commodities complex is starting to respond. We've talked about gold and silver. If we think about copper, the classic growth and infrastructure bellwether, it's certainly signaling supply stress rather than demand collapse. So tariffs, energy transition, defense, AI, all point to real resource constraints as it pertains to copper. And so for multi-asset practitioners, this isn't about making a call as such. It's really about recognizing a regime where policy anchors the belly of the curve, fiscal dynamics are pressuring the long end of the curve, and whether real assets are re-entering the conversation as a structural allocation. Are they a diversifier? So this is less about prediction and more about structure and the debate around that. A stable belly of the curve, pressure at the long end, and renewed signals from real assets all point to deeper debate needed around duration, diversification, and portfolio resilience.